The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A bit of a market standstill amid the latest standoff between the U.S. and Iran. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Isabel Lee. We're kicking you to the close on this Monday morning here in the U.S. We're looking at a board that's green on the screen. We have the S&P firmly in the green after briefing to the red ever so slightly at around 1:13 p.m. today. We have the CBOE index, or more commonly known as the VIX, Wall Street's fear gauge, up at a 24 handle after closing at its lowest level in 2 weeks on Thursday. Friday was a holiday. Bitcoin, of course, we can't not talk about it. We saw this coin up at around 70,000 today. That's the highest since March 25. And lastly, we're looking at Brent crude. It's still trading at above $100 per barrel. We have traders really focused on the real-world locations of the movement of the oil barrels. Back to you, Romaine.
All right, when we talk about stocks, we should know coming out of the Easter Sunday and still amid the Passover holiday, the price action and volume is weak, and the benchmark S&P still trading below that 200-day moving average, with oil prices drifting back above their 20-day average. Adding to the stasis, the latest ISM survey that shows U.S. businesses, they're experiencing a sharp run-up in cost pressures that's actually weighing on the broader services economy. We're going to talk about that in just a second. But there is a tinge of optimism out there, or at least a bit of wishful thinking. Morgan Stanley strategist Mike Wilson says U.S. stocks actually might be bottoming out, and he recommends adding exposure to cyclical and quality growth where earnings there remain strong, valuation compressed, and sentiment, in his view, still negative. But here, on the eve of the start of this new earnings season, conviction behind adding to that exposure, it's still contingent on reducing the economic risk from the war. It's a risk some on Wall Street say is still being underpriced, particularly after Trump's press conference today, which didn't seem to convey any sense of closure to a conflict and disruption now in its sixth week.
I don't know. I can't tell. It depends what they do. This is a critical period. We're giving them till tomorrow, 8 o'clock Eastern time, and after that, they're going to have no bridges. They're going to have no power plants. Stone Ages, yeah.
President Trump speaking just a few moments ago at the White House. Here in Studio 2 in New York is Kristina Hooper, Chief Market Strategist over at Man Group, kicking us off to the close here on this Monday afternoon. And Kristina, this is the question now for the markets right now, whether we are potentially going to see some sort of closure or sort of move towards closure of what's been happening in the war. But more importantly, this idea as to whether the market has appropriately priced in both the short-term risk and the long-term.
And I think that to answer that question about whether it's priced in, I don't believe it is accurately priced in at all. I think thus far, what we've seen is a market that's treating this almost as if it's another Liberation Day tariff scenario, where the decisions can be unilateral and the president can put on and take off tariffs at his discretion. This has multiple players involved, and no matter what the U.S. does, Iran has a mind of its own. We have other countries involved as well. So I think this is a much more significant issue, and we're just not seeing the market react even as much as it did in the initial stages of Liberation Day, post-Liberation Day.
Particularly when you look at oil prices, and not just being elevated, but the idea that now they've kind of been sustaining themselves in that $100 plus range for quite some time now. I know we're not at the extremes of what we saw in 2022, but do you fear that just staying at these levels can have a material impact, not only in the markets, but for that matter, on earnings?
Oh, absolutely.
Yeah.
I mean, if we look at some of the most recent economic data we've received in terms of the PMI surveys, what we're seeing is very significant weakness when it comes to consumers. What we're seeing is a reduction in spending. There is a lot going on in terms of affordability pressures. That is only going to get worse. We're only just catching this in some of the data, and I think it's going to get worse from here quite significantly.
We have Jamie Dimon saying there are two fat tail risks: inflation, which has been sticky, and of course a slowdown in growth. Which to you is more problematic?
Well, that's the $64,000 question. I think we have to ask ourselves, which is going to be more problematic for the Fed? And so the Fed got a jobs report that looks on its surface to be quite positive. So I think they're going to be focused on inflation. And we did see, in fact, the prices paid sub-index for services PMI today show a very big jump. in prices. And so I think they're going to be focused on inflation, which is bad news for the stock market.
And given how you're seeing conflicting signs in the markets, from 2-year yields to gold to stocks, which to you is the asset class that you believe in the most and which do you have more conviction in? Or most, I should say.
I think typically what we've seen over time is that treasuries can be a very good gauge. Not perfect. There's nothing that's perfect, but I do think that treasury is certainly far more than the VIX can give us a sense of where the concerns are. And what we have seen is yields go up this year, only probably about 15 basis points, but it's significant. We've seen yields go up far more for other countries because they're facing a lot of the same issues in terms of widening fiscal deficits. This only aggravates it in terms of high elevated oil prices that remain for some time.
It's interesting you bring that up. I mean, there was actually a great column today by Ruchir Sharma over at Rockefeller in the Financial Times, kind of talking about this issue of the fiscal situation of a lot of nations, particularly outside of the U.S., and they're not really having the fiscal ammunition to actually fight back against the prolonging of this war and the economic effects of it. If we do get to that situation, though, is there not a policy response that you see potentially maybe being able to blunt the impact, whether it's monetary or fiscal?
I think the policy response would have to be fiscal. If we look at what impacts Main Street, it's typically fiscal policy, not monetary policy. Compare the global financial crisis, when the response was primarily monetary policy, almost exclusively. What we saw was the stock market recover a lot more quickly than Main Street, than the overall economy, and certainly jobs. When we have a fiscal response, let's look at the pandemic. What we saw was pretty fast and significant impact to the economy, to Main Street. Now, it also helped Wall Street, but it certainly helped Main Street.
I do want to get your thoughts, though, about earnings season. We've seen earnings estimates, at least in aggregate, start to come up. And obviously, this is a little bit backward looking because we're looking at the past 3 months here, and who knows what the next 3 months will look like as well. And investors today buying heavily into financial stocks with the idea that we might get some good earnings reports out of them next week here. Are you optimistic, A, about the earnings season for the 3 months that just passed, and more importantly, about the forecast we might get for the months going forward?
So for the most part, I'm optimistic about this earnings season because it is backward looking, with the exception of consumer cyclicals. I think we're going to certainly see some retailers that have already started feeling significant pressure because of the affordability crisis. Going forward is another story, and I think we could soon get guidance from at least some of the companies around their diminished expectations for the rest of the year, or at least the next quarter, because profit margins are definitely going to be coming down in this environment.
All right, Kristina, always a great conversation. Great insights out of Kristina Hooper, Chief Market Strategist at Man Group, kicking us off to the close on this Monday afternoon. When we come back, we take a deeper dive into the broader implications of the Middle East conflict. We're going to talk about the supply chain, and we're going to do that with Flexport CEO Ryan Petersen.
Plus, is this a truce between Iran and the U.S. even feasible? We'll get perspective from Brigadier General Mark Kimmitt, former Assistant Secretary of State for Political Military Affairs. And
we talk about the impact on the energy market, and more importantly, what options there are to blunt that impact. Ernest Moniz, former Energy Secretary here in the U.S. and the founder of the EFI Foundation, he joins us in just a bit as well. Stick with us. This is The Close on Bloomberg. Well, we heard from President Trump earlier today, and we also heard him put the U.S.'s role as a global shipping guardian at stake as threats to withdraw from the Iran war. European and Asian officials, they're telling Bloomberg that the war has actually broken down confidence in the U.S. as that protector of the high seas. It's raising a lot of questions here about just what options out there are for one of the key shipping routes in the world. Flexport CEO Ryan Petersen, he joins us right now. His company specializes in supply chain logistics, and he keeps a close eye on the flows or lack thereof. And Ryan, a lot of questions right now, not so much just about what's coming in or out of the Strait of Hormuz right now, but about the broader health of the supply chain, whether we need to start thinking about it, at least right now, in a different light.
Yeah, absolutely. Thanks for having me on. It's the Strait of Hormuz is obviously massively important for energy, for fertilizer, which is really under covered here, and many other kind of precursors, like helium, for example, is one of the main required elements to produce semiconductors, and 30% of it comes from Qatar. So you're gonna see broad implications for this. And then, in my world, which is container shipping, air freight, you see big increases. We're seeing prices have gone up a lot, not just to the region, but for freight that's coming from Asia to Europe, for example. We had just started to see container shipping return to the Red Sea, and they're now going around Africa again, which they've been doing since the end of 2023. Air freight prices have doubled on that trade lane. So it's definitely having massive economic implications well beyond just the region.
Have you actually seen any sort of indicator that we could see a slowdown in shipping activity and economic activity? There was another report today showing just freight rates, some of the shipping rates here in the U.S., the fuel surcharges being added, also sort of bumping up the cost of that as well.
Yeah, definitely. I mean, we've already seen prices spike on Asia to U.S. lane, which, on the surface doesn't seem that connected. If you're shipping from Vietnam to the West Coast of the United States, the price of air freight has gone up about 60% on that lane. Ocean freight, similarly, we were expecting to see very cheap ocean freight this year. There's a lot of excess capacity of ships, but now with this disruption, it's caused, there's some degree of opportunism and some degree of just supply and demand. Ships that were supposed to be going into that region are either trapped or being rerouted. A lot of congestion in the ports, which is causing, increased prices.
Ryan, do you think the current tension could trigger a global scramble of oil and maybe even essential goods?
I mean, yeah, I think that's the big concern here. 20% of the world's oil flows through the Strait of Hormuz, and you take off 20%, take that 20% out of supply, you're going to see major implications for that. It's actually a little bit hard to get a picture because I thought actually the Citrini analyst who went down there in firsthand and showed that actually 50% of all the ships transiting don't have their AIS transponder on. There was an analyst this week who went in person to the Strait of Hormuz and covered it. And so actually it's hard to get good data about what's really happening. Maybe it looks like more oil is flowing out than is getting covered because so many people are relying on satellite data. And nonetheless, it's also hard to get a good picture of what are the reserves. I've heard reports that Taiwan is getting low on natural gas, and if they don't start seeing more ships coming out of the Strait of Hormuz, you're going to see major implications there. And some countries just won't be able to afford it. Philippines, Laos, there's some countries that are much lower in the income stack that buy most of their oil from that region and are now cut off.
Yeah, in some corners of those worlds that you mentioned, oil prices have doubled and some have actually imposed work from home mandates. From your vantage point, are there any risks that the market hasn't priced in just yet?
I mean, it's a huge risk. And fertilizer probably being the biggest one in terms of food production. That, it's one thing for energy prices to go up. It's another thing for just not to be enough food produced. Now, we've seen this in the past where Russia and Ukraine, there was major fears that as the biggest grain exporters in the world, and fertilizer exporters too, with that conflict, that it would get cut off. The UN stepped in and created this Black Sea mission to get grain exports flowing, and the fertilizer never stopped from Russia. So. And also what happened in that conflict was that the Gulf states stepped up production of fertilizer and urea and other inputs, phosphates for fertilizer. And yet now if the backup plan has now become the bottleneck, I think there's a big risk there. And food supplies is the kind of thing that, that's where you get revolutions, is when there's not enough food. So, yeah, big risks that haven't been priced is my read.
I do just kind of want to go back, though, to also what we're seeing in the air here, Ryan. And I know you track a lot of these sort of connections between what we're seeing on the ground, in the water, and in the air, with some of the commercial flights disrupted as well, which are also, to a certain extent, double as cargo flights, depending on the airline here. Have those found new routes, or are those effectively lines of supply that, at least for right now, are shut down?
Yeah, the air freight market's heavily impacted right now. So about 18% of the world's air cargo capacity is operated by Middle Eastern airlines. I think Emirates, Etihad, and Qatar Airlines in particular. And so a lot of that is belly of the passenger planes, and then they have dedicated cargo planes. That's severely impacted. It's gone up and down. At some point, they were back to operating about 40% of flights. And then there were some attacks at the Dubai airport in Qatar. that brought it back down. So we're now seeing 10 to 20% of flights operating. It's a huge impact. So freight from Asia to Europe often stops in the Middle East to refuel, to be a hub for transshipment. And so those are heavily impacted. You're seeing the airlines have to route around. So India has picked up a lot of volume. Egypt and Turkey are all serving as sort of refueling bases for airlines. And then we're getting creative as an industry. So for example, my company, Flexport, launched a new service where we'll do fast ocean freight from Asia to the United States across the Pacific, and then fly it from LAX to Europe. It's faster than going around by ocean, and it's cheaper than flying direct air freight. So you're seeing the industry route around these things.
All right, Ryan. Well, obviously, you always have your pulse here on exactly everything that's going on. Always appreciate it. Flexport CEO Ryan Petersen there as we continue to count you down to the close with a special focus today on the situation in the Middle East. And when we come back, we continue that coverage with a closer look at the shares of defense and security company Kratos. They're on the rise after an upgrade by Jefferies. We speak to the analysts behind that call when we come back after the break. This is Bloomberg. All right, time now for our top calls. The big movers on the back of analyst recommendations. Let's start off today. We're going to do it with Netflix. Goldman Sachs upgrading to buy. The price target going to 120 from 100. The analysts expecting Netflix's earnings report next week to reflect, quote, a strong start to 2026. Those shares having a strong start, well, not somewhat strong start to the week, up a second straight day. Next up, Carvana. Bank of America downgrading to neutral. The firm seeing the recent oil shock potentially pressuring an already stretched lower and middle income consumer. Those shares, though, up for a second day as well. And finally, let's take a look at Kratos. Jefferies upgrading the drone developer to a buy, but they're maintaining a price target of $85. The analyst says that growth is bolstered by increasing demand for more affordable yet advanced autonomous missiles and drones. Those shares having their best day in about 2 months. And those are some of our top calls. And we do want to stay on that last one for a second because Kratos, it's been in the news a lot lately, particularly with the war in Iran and, of course, with a new proposal for the U.S. Pentagon's defense budget. Sheila Kahyaoglu joining us right now, Senior Aerospace and Defense Equity Research Analyst over at Jefferies. All right, Sheila, let's start off first with Kratos, still developing out, of course, that key drone, that Valkyrie drone that everybody's been talking about. But investors seem to be convinced that when we talk about the future of warfare, and more importantly, the future of what the Defense Department will spend on, it will be on the types of drones that it's developing. Is that how you see it?
Yes. Kratos has leverage to drones, which represents about 20% of their sales. Missiles is another 20%. We see those areas of the budget growing, and we see this administration very supportive of affordable, scalable solutions and dual sourcing. So essentially creating the mid-caps of today, which Kratos is, having them become the primes of the future. So I think Kratos fits those themes really well. The stock is down about 25% over the last month since Iran started. And I think this provided a great entry point for us.
What does sort of production ramp up look for a company at this size right now, both on the drone side and the missile side?
Yeah, speaking to their CEO, Eric DeMarco, he's not really betting on the production scale up for their Valkyrie solution, which he's producing about 6 to 8 in 2026. That could go up to 40 in a blue sky scenario in 2028, which he has the capacity to do so in his Oklahoma facility. So that would be pretty easy to do. The ASP on the Valkyrie is about 20% of what the larger drones and larger solutions look like. So it would be a more affordable solution. So for now, there's no capacity restrictions. But of course, once we see initial orders, the 40 might just be a first stepping stone in what production could look like for the Valkyrie.
Do you think we're seeing a new era of drone-driven warfare shaping budgets, especially with demand for tactical drones surging?
Yeah, I think there was comments from the French government this weekend talking about increasing munitions and drones, something like 400% capacity increases. So I think we're seeing affordable solutions, especially what's going on with Iran. We have missiles that are $5 million to $10 million being shot down by, or, playing against $50,000 missiles. So we have a math problem there where we're shooting down with expensive equipment. Where our enemy has, lower cost solutions. So I think we need more affordable solutions, which Kratos plays to. For instance, within its engine franchise that power some of these missiles as well.
Let's take an even bigger step back. Talk to us about how U.S. defense spending is evolving when it comes in response to conflicts like the one we're seeing in Ukraine and the Middle East.
Yeah, a bit surprising today. The fiscal 27 budget was released, the president's request on Friday. Of course, the market was closed, and we're seeing a fairly muted reaction from defense, at least the defense primes like Lockheed and Northrop. But the defense budget is calling for a $1.5 trillion budget, which is over a 40% increase. Of course, some of that comes, the base budget is growing about 30%, and the rest is from a $350 billion mandatory reconciliation bill. So we're seeing the Trump administration request a big increase in defense spending. We're seeing that across multiple categories with no service essentially left out.
I am curious, though, too, you talk about the muted reaction. I mean, look, we know that to a certain degree, we still need these larger, more expensive programs, including whatever this next generation fighter that Boeing is building here. But do you see a potential where we're going to start to see these budgets shift a little bit more to, I guess, the smaller or relatively newer players? Or is the bulk of this still going to stay with the RTXs, the Boeings, Northrops, et cetera?
I think you'll see winners across the board. I think you'll see top line growth drivers, whether it's missiles. We have average missile programs growing 8%. We've only seen frameworks for 4 out of the 20 major programs. So we could continue to see frameworks. We could see this administration supportive of profit margins by signing 7-year frameworks. So a prime knows how many folks to hire over 7 years versus reordering every year and renegotiating those contracts. So I think that's a benefit for the primes overall. We've seen a reinvigoration in the F-35 request. But also what I think is important with this administration is that they're really supportive of smaller players. They want success. They want dual source. They see what strain the supply chain has, and they want to make sure that they have not only 5 major primes, but a slew of other players in the defense industry, which is helping folks like Kratos.
All right, Sheila, always appreciate it. Sheila Kahyaoglu, Senior Aerospace and Defense Equity Research Analyst over at Jefferies. Kratos shares up about 10% here as we move closer to the closing bells. When we come back, we continue to focus here on the situation in Iran. A conversation up ahead with retired U.S. Army Brigadier General Mark Kimmitt. We're going to talk to him here about some of the military options to potentially bring this war to a close and get the Strait of Hormuz flowing once again. This is The Close on Bloomberg. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Isabel Lee.
It's been an interesting day in markets. We should point out there's obviously a lower volume day with basically the Easter and Passover holidays. A lot of folks still away here. But we talk about the moves that we continue to see in oil prices. We had settlement once again today, well above $100 a barrel on both Brent crude and WTI crude. And we just had that big press conference by the President of the United States alongside his defense secretary. And it didn't really seem, at least for right now, there was going to be sort of an imminent end to what's been going on over there.
It actually was very interesting to watch because President Donald Trump said that Iran talks are going well ahead of the Tuesday night deadline, but investors we're talking to still are confused what the end game for this is. But beyond the geopolitical risk, we're looking at a still resilient economy. Earnings are still constructive. The Friday payrolls report, it was a holiday, but there was the payrolls report. It still put the Fed at a luxury of a wait-and-see mode.
Absolutely. And, of course, we get the earnings season. Actually, kind of ostensibly kicks off in a couple of days with Delta, but really next week when we start to get the big banks and a lot of companies, CEOs and CFOs, going to have to answer a lot of questions about the economic situation, at least as they see it going forward. As far as the conflict itself that's going on over there, a lot of questions as to how to bring it to an end and what options, at least from the U.S. side, are actually right there on the table. Retired U.S. Army Brigadier General Mark Kimmitt joins us now. He's also the former Assistant Secretary of State for Political Military Affairs. General, I do want to start off first with this general idea about the potential reopening of the Strait of Hormuz, whether the U.S., can actually be involved in that, and I guess more importantly, whether it actually wants to be involved in that.
Well, those are both good questions, Romaine. Look, I think the best precedent is the 1981 to 1988 tanker war. You may remember it. At that time, we reflagged the Kuwaiti tankers and took them through the Strait of Hormuz. Now, we were a non-belligerent in that operation. We were not at war with either Iraq or Iran. This time, it would be far more difficult for the United States to do that because we are a belligerent. We are a party to the conflict. So I think that that is the rationale that is being used to seek assistance from the allies to have them perhaps reflag the tankers and escort them out, because then that gives Iran the question about whether it wants to start a war with France and Germany and the United Kingdom and possibly China.
I am curious, though, about, and I know there's a lot that we don't know publicly about Iran's military capabilities, but of course, with the U.S. jets that were basically shot down, or at least crashed, we should say, in that territory, and thankfully we had the rescue of that airman who had been out there. It is raising a lot of questions about what Iran's current capabilities are and whether that potentially blunts the impact of some of the traditional U.S. military options.
Yeah, I think that everybody's been surprised at the resilience of the Iranian military capability. In fact, just the simple numbers that are remaining. Now, it could well be that we've taken down 90 to 95% of their air defense, their missiles, and their drones. But as we saw over the weekend, that does not mean they have no capability. So I think that we're going to see our operations be a little more skittish and a little more conservative, recognizing that they still have capability, albeit small capability.
So if Iran keeps resisting, what's next for Washington? We have President Trump saying that if Iran does not agree to his terms, the military could destroy every bridge in Iran.
Well, you've said two different things, and they both overlap. Number one is resistance. It is a resistance model that the Iranians are using. And the resistance playbook is very simple. You win by not losing and have patience. So as we've seen in other conflicts, such as Afghanistan, it's clear that the Iranians are willing to stretch this thing out. Now, can the military attack their infrastructure? Yeah, that's a fairly straightforward operation, but it comes with a whole furball of other problems, primarily that of reciprocity against our Gulf allies. The Iranians are very good about metering out their responses. If you attack my desalination plants, we're going to attack yours. If you attack our oil facilities, we're going to attack yours. And you, more than anyone else, certainly would understand the impact on markets if we started to have this tit-for-tat type of exchange of high value, world important assets such as that kind of infrastructure.
General, how do you think U.S. allies might respond if tensions continue to escalate then?
Yeah, I've seen Britain hosting a number of conferences to see if they can set up something separate. I could certainly see them working a situation where they would float an armada of some kind, where they would guarantee Iran they would have no affiliation or take no support from the United States. That was similar to a process that we ran with counter-piracy operations in 2009. The EU had a completely separate operation from the United States.
Mark, I do want to talk a little bit just about kind of the long-term nature of our U.S. military, kind of the reshaping of it. There was a lot of talk, of course, about this $1.5 trillion budget proposal for the U.S. military, basically the biggest increase on a percentage basis since World War II. But also the idea of how that money would be spent. And caveat, this is obviously a wish list right now, and it'll be pared back by Congress. But typically this money goes to the big contractors, your Boeings and RTXs, Northrops. But there have been a lot of questions as to whether we should be investing more in some of these lower cost drones and lower cost missiles to kind of counter what we're starting to see with the conflicts we've been involved in, where we're fighting militaries that are a little bit more nimble, not necessarily because they're better than us, but because they have to be more resourceful because they don't have our resources. Where should that money go?
No, you're really right. I mean, the fact remains is that a significant lessons learned from these operations, both in Iran and Ukraine, is the ability of small to medium-sized enterprises being far more nimble and far more adaptive than the big defense contractors. The paradox, of course, is once those small companies start getting big contracts from the Lockheeds, the RTXs, and so forth, they get bought by those companies. Esusu is a great example, which had probably some of the leading edge drone manufacturing years ago, and they were bought by Boeing.
Well, but this does seem a little different now in terms of the crop of companies that are out there. Some do seem relatively intent on building out their business model on their own without necessarily being bought. But also just the way that some of these, let's just say younger companies and their CEOs are just thinking about modern warfare and what technology capabilities we have as a nation that can be scaled up in a way that's going to be not only beneficial to us in terms of protecting us, but maybe potentially more cost effective for the Pentagon.
No, again, I think you're right. You take a look, particularly in the area of AI, how much the smallest of the small companies are really coming up with some innovative capabilities. I mean, 5 years ago, Palantir was a very, very small company, and look at it now. And I think you're going to see in one area I've particularly watched, which I'm surprised that people haven't been jumping on, is not drones, but counter drones. If, in fact, drones are omnipresent on the battlefield right now, there's a lot of money to be made by the small companies that are going to make small, cheap counter-drone capabilities, suicide drones that don't necessarily attack the enemy, but attack their drones. And you combine that with artificial intelligence, and I think what you do at that point is neutralize the threat. And most of the capabilities that I'm seeing develop in that particular niche are coming out of small companies.
That's interesting. I hadn't thought about that. We have to get you back soon. I have to leave it there, General. Always appreciate your time. Retired U.S. Army Brigadier General Mark Kimmitt there. Now, when we come back, we're going to continue to count you down to the close. We're going to make a little bit of a pivot, though, and talk about what's been going on in crypto. We did see Bitcoin top 70,000 at one point, but all the talk today is around strategy. The company posting a $14.5 billion unrealized loss for the first quarter. In its shares, they're up 6%. It's our stock of the hour. We'll explain when we come back. That's coming up next here on The Close, right here on Bloomberg.
Shares of Strategy climbing today despite registering some $14.5 billion in unrealized loss for the first quarter. The Bitcoin buying firm, formerly known as MicroStrategy, is largely keeping pace with Bitcoin, which has posted its worst first quarter since 2018. Joining us live with more is Bloomberg TV Markets correspondent Norah Mulinda. So, Norah, talk to us about this loss. It sounds really huge, but shares are in the green.
Right. So we are seeing the market reacting because we have to also realize that this is unrealized loss. That's meaning a paper loss that's more or less based on current crypto prices. It's not necessarily cash out the door. So I do seem to see a bit of the market really thinking about that. But it's also just this idea about how crypto has been doing more broadly that's also been kind of in focus as well. If you take a look at the chart of MicroStrategy or now Strategy against Bitcoin, it's almost identical because people think of Strategy as essentially a proxy for crypto, a way to get crypto exposure, almost like an ETF, if you will. It's the largest corporate holder of Bitcoin. So whenever you see some sort of reaction in Bitcoin, you're going to also see a similar reaction in Strategy. But here we are seeing essentially the market saying, hey, this isn't necessarily something that we've really been seeing in terms of cash actually leaving and Strategy actually selling Bitcoin.
So, I mean, one of the bright spots apparently was this idea, too, that they have, whatever cash they have on hand, enough to make good on those distributions and any interest they need to pay. But what about additional Bitcoin purchases? Because usually I feel like anytime you see Bitcoin prices get depressed, then Michael Saylor comes out and he's talking about how he's buying it like it's going out of style.
Right.
I haven't seen him lately.
Right. I mean, that too. But I will say that it does seem as though they're doing a bit of a strategic shift here. So you are seeing them really leaning toward the preferred shares. So I think it's called Stretch, actually. It's Stretch preferred shares. They're thinking about this essentially as a vehicle. So they're actually able to issue preferred shares instead of potentially issuing, common shares, in which case would dilute existing shareholders. So if they lean into the preferred route here, they're actually able to avoid that dilution. But it does actually add, of course, some of those fixed obligations. Quite creative to say the least.
Okay.
So is this a company story or more broadly a crypto story when it comes to how the strategy is in the green and even Bitcoin?
Right. I mean, it's interesting because they are linked in so many different ways. But what you're really seeing here when we see Strategy in the green, where you may expect it to have actually been in the red off of this news, it's people thinking about the future. So we've already seen that Bitcoin did log a pretty brutal quarter when we think about the first quarter of the year. Strategy as well, of course, suffering based off of the price of Bitcoin falling. But people are really betting on the future and essentially seeing a potential turnaround, maybe perhaps, first strategy. And of course, any sort of move that you see with Bitcoin, you're also going to see that similar move in strategy shares.
All right, great stuff, Norah. And I really appreciate you wearing a Northwestern Wildcat colors today in support of our alma mater. Bloomberg Markets correspondent Norah, Mulinda there. A closer look there at strategy. Always a fun story. And of course, Bitcoin still camped out, Isabel, right around that 70,000 mark. The good news, though, for stocks at least, we're actually not far from session highs here. Modest gains, but still somewhat of a bright spot.
It's actually unbelievable how stocks are not really reacting to geopolitical news, actually.
6608 right now on the S&P 500. Mandy Zhu over at CBOE. She joins us next.
I don't believe it is accurately priced in at all. I think thus far, what we've seen is a market that's treating this almost as if it's another Liberation Day tariff scenario, where the decisions can be unilateral. I think this is a much more significant issue, and we're just not seeing the market react even as much as it did in the initial stages of Liberation Day.
Kristina Hooper, Chief Market Strategist over at the Man Group. She kicked us off to the close just about 15 minutes ago. Stocks, at least right now, Isabel, not far off session highs, so a market on lighter volume, at least trying to find the silver lining.
Not far from session highs, and it's set to post its longest advance since January. So it's really interesting to see equities really just sporting this optimism, but I guess it's because we're still seeing a resilient economy. And we have an article just out by Alexandra Semenova saying that April is seen as a good month, and a large part of that is because retail traders are buying because of the tax deadline.
Yeah, and we also had a bad March.
That is true.
And then you throw in that, and it was kind of interesting. There were a couple interesting notes out over by Goldman talking about some of the fast money traders maybe having hit bottom. Of course, Mike Wilson over at Morgan Stanley making a similar case on a fundamental basis that maybe we've seen potentially the bottom of this potential market cycle. And you have earnings kicking off, so maybe you start to get some actually good news that's not related to geopolitics.
That's absolutely right. And I want to hone in on that Goldman note, because do fundamentals even matter? Everything seems to be momentum driven. Like you see big money buy from hedge funds to big institutions. And really, that's what's moving markets. We cover ETFs, and a lot of it is systematic. So who knows? Maybe fundamentals will take a backseat.
Absolutely. And that's actually a great setup for our next guest, who covers options and derivatives market like no one else. Mandy Zhu joins us here in Studio 2, head of derivatives market intelligence at CBOE Global Markets. Mandy, great to see you.
Great to be here.
Well, let's talk a little bit about that. I mean, obviously, we know fundamentals matter to the market, but so too do a lot of the technicals. So too does a lot of that momentum. What do things look like right now? Has there been any material shift over the last few weeks?
Sure. If I can summarize kind of what I'm seeing in the markets right now, I would characterize it as cautiously optimistic. So optimistic, obviously, in the sense that we've had this big risk-on rally over the past week. Volatilities across almost all asset classes have fallen pretty significantly over the past week. But cautious in the sense, if you dig a little bit deeper in the positioning in the options market, it's actually fairly contrarian. Traders have been really fading this risk-on rally. So, for example, in the equities market, we're seeing obviously SPX rally quite a bit. The predominant flow that we saw last week was traders coming in to sell upside calls in the market. So a big part of why the VIX fell so much was actually people monetizing their upside call positions or overwriting, taking the view that upside from here is actually likely to be limited. So fairly contrarian, and we see it also in gold. We see it in the fixed income market. So across markets, positioning, there's been a pickup in hedging demand and a lessened demand for upside.
Is some of that at all, do you think, tied to the potential start of the earnings season, or is it kind of divorced from that?
I would say right now it's very much still headline geopolitics driven, Iran driven. Now, as we get closer to earnings, obviously earnings kicking off next week, could we start to see more of a shift to fundamentals? Yes, but if you look at broader levels of correlation, of dispersion, all of that is now actually pricing a little bit more macro risk into the market, a little bit of a shift away from the idiosyncratic, from the fundamental risk.
We have short-term hedging picking up, but long-term protection is kind of calm. What's behind that gap?
Yeah, I think it's, again, to the point of right now it's just a headline-driven market. A lot of uncertainty regarding Iran. Where's oil going in the near term, longer term, and I think right now the market is still pricing this to be, at least in the equity market, pricing this to be a fairly short-term event. So longer term, you're not seeing that pick up in longer term, like 6-month, 1-year hedges. It's more kind of hedging the near term. What's going to happen this week? What's going to happen, in the next couple of weeks? So there's that divergence in terms of where equity investors, equity traders see risk. Now, we've been highlighting the contrast between equity market and, say, oil market, where in the oil market, there's been persistent hedging demand. So even if you look out 6 months or even longer, there's a lot of outsized call demand. So people hedging for continued upside in oil in the options market that you're not really seeing in the equities market.
What are they pricing in when it comes to oil? Any specifics that you see?
So I think the strikes in terms of what it's been trading is obviously varied, but what is interesting is that skew is inverted in oil, meaning that calls are trading at a premium to puts. That's the case whether you look at 1 month options, 3 month options, or 6 month options. The longer data skew being inverted is actually very rare. It's only happened 3 times in the past 20 years. So that's something that we've been highlighting and if you look at last week, the broad risk-on rally that we had across asset classes, guess what wasn't part of that party? It was oil. Oil prices ended up higher on the week. Oil volatility was still pretty firm last week, even as equities and fixed income, everything else rallied.
So what is that correlation looking like right now with the increase in oil prices and equity markets? Because we had a great week last week, up like 3% on the S&P, and we're starting off this week with some modest gains. Yeah, and yet oil's at what, 110, 111 bucks a barrel?
Yeah, as you can imagine, these macro cross-asset correlations have really broken down in recent weeks. So equity oil being obviously the one that a lot of people are focusing on. But I would say for most multi-asset portfolios, the one that's really been hurting a lot of investors is that equity bond correlation, right? So bonds no longer becoming as effective of a hedge in a 60-40 or a multi-asset portfolio, that equity bond correlation turning sharply positive in a more inflationary environment. That has been a definite sore point for a lot of investors.
How much do you think we'll start to see a little bit more pricing in of higher inflation, particularly in light of the official data we got from ISM, at least for the services economy, but also a lot of industry data coming out showing, elevated rates for shipping and fuel surcharges and a lot of other things coming now into the U.S. economy?
I certainly think it will trickle through. Now, the big question is just, how patient will the Fed be? When we do get that inevitable pickup in headline inflation, and Powell obviously came out last week and said they're going to take a wait-and-see approach, and that I think is a big part why rates volatility fell so much last week. But if you look at positioning in the bond market, again, there's much more hedging activity going on right now. So traders positioning for the potential for higher yield, higher rates, not just for short-term bond yields, but longer-term bond yields, and that really is a big driver of that is higher inflation risk.
30 seconds here. Talk to us about the VIX. Is this real calm or just positioning?
It's both, I would say. Obviously, VIX fell last week in large part because the S&P rallied so much. But below the surface, as I mentioned before, we are seeing a notable increase in hedging demand and a decline in upside call demand. So traders really taking the view that upside likely to be limited. We're not seeing that upside chasing this time around that we saw maybe in prior sell-offs over the past year.
Mandy, always a pleasure. Mandy Zhu, head of derivatives market intelligence over at CBOE Global Markets with the majority S&P stocks, Isabel, in the green, getting some big contributions from Apple, Amazon, Alphabet, the names you would expect. But on a percentage basis, it's kind of a hodgepodge of companies. You have some in the energy space, some in the consumer discretionary space like Starbucks, and then you have staples like Clorox in there, up 4%.
We have Ed Yardeni saying tech stocks have returned to their attractive levels because investors are willing to play the long game. So that was interesting to me because for the longest time, a lot of these folks have been saying tech is really expensive. Now,
does a long game, does that include the AI disruption or not?
Probably.
I've been using that Claude. I was on a road trip this past couple weeks. I just, everything I did with Claude. Thank you, Anthropic. A full breakdown of all of today's market action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Isabel Lee. Katie Greifeld on assignment. We're taking you through to the closing bell here with the global simulcast. Carol Masser and Tim Stenovic. Well, they pop up there on the screen and on your eardrums. Welcome to our audiences across all of our Bloomberg platforms, television, radio, and our partnership with YouTube here. Carol Masser on this Monday afternoon. Modest gains for U.S. equity markets.
And welcome back to you. We definitely missed you. You missed a lot. There was a lot going on. Having said that, what's interesting coming off
was there really a lot going on? It seems like a lot of the same.
Well, maybe, but we were bouncing around a little bit. And I hear where you're coming from. I mean, has anything really changed in a week? Maybe, perhaps not, except that this war is going on even longer. And I kind of feel like coming off that 80-minute press conference, there was a feeling perhaps in markets that maybe investors weren't buying anything too much and figure that this could go on for a little bit longer.
Did you listen for the entire 80 minutes?
Not all, but a lot.
Yeah, we did.
We listened to most of it.
Wow.
Yeah.
We had to. It went into our show.
Yeah, we kind of need to be ready for it.
Okay. All right.
Yeah, look, the big question is what happens tomorrow, 8 p.m., and does the president follow through? with the latest threat.
8 p.m. Is it 8 p.m. or midnight? I'm so confused.
8 p.m. is the deadline.
Yeah, then, at midnight, then the...
4 minutes, he said, 4 hours to kind of really get rid of everything in Iran.
So, look, I don't know what the equity market is saying. I know the oil market is still saying that oil is still high.
Yes.
So...
It is.
Is that a bet that the Strait of Hormuz, Romaine, is going to open soon? I don't know. Sorry, Isabel.
Well, it gets to the idea, too. I mean, we talk about, at least here, in the interest of serving the financial markets, the idea of when this actually does, if at all, have a material impact on corporate bottom lines on the eve, of course, of earnings season, and still waiting any sort of economic data that would even sort of reinforce the idea of sustained inflation and, more importantly, any sort of sustained drop in economic activity. At least for today, we're not getting that. The Dow Jones Industrial Average closing higher by about 165 points or 0.4%. Similar gains across the board on a percentage basis, with the S&P 500 adding 0.5%, the NASDAQ Composite adding 0.5%, and the Russell 2000 up on the day by about 11 points or 0.4%.
All right, so some moves there to the upside. Let's go back to the S&P 500, the big caps. And Isabel, you've got about 324 names to the upside for the Monday trade, 176 lower and 3 unchanged.
That's a big gain. We're looking at the IMAP and we're looking at all the 11 sectors, most of them in the green, just 2 in the red. We have the biggest gainers there being technology and consumer staples. Consumer staples up by 0.4%. The biggest losers are healthcare and energy, which is not really a big surprise.
All right, a lot of green on the screen, so I had a lot to choose from. So let's go to it. Seagate Technology up about 5.6% in today's session. Western Digital also higher, up about 3%. I bring them 2 names up. They were outperformers in both of the major equity averages. Morgan Stanley raising its price target on Seagate, the computer hardware and storage company, to $582 a share from $468. The firm also named Seagate its top pick, seeing long-term tailwinds related to AI. The analyst there citing signs of sustained hyperscaler demand strength, elongating customer visibility, firmer pricing into 2027, and an overall improving HDD end market due to AI-related demand. They put overweight ratings on both Seagate and Western. Morgan recommending adding aggressively to them in periods of market-related volatility. Morgan also lifting its price target on Western Digital to $380 from $369. So Seagate up about 5.6%, Western Digital a gain of more than 3%. All right, let's flip it on over to AppLovin. Another call from Wall Street. This was, I believe, the #1 gainer in both the S&P and the NASDAQ 100. Wells Fargo analyst raising the firm's price target on AppLovin to $560 from $543 a share. Stock closed at $412 and change. So quite a move to the upside if it hits those targets. Keeps an overweight rating on the shares. The firm says checks are improving and buy-side sentiment is negative. Wells sees a positive setup into the first quarter earnings per share. Channel checks suggesting that the first quarter IAA industry growth above normal seasonality. AppLovin holding share in Meta Platforms. Progress limited the firm's ads. A lot of analysts speak there. But anyway, outperformance there. That went up almost 7% today. And one last, we don't talk about it a lot, Monolithic Power. This went up about 5.5% in today's session. #4 gainer in the S&P 500. Reader interest increasing, no real fundamental reason. It's a semiconductor device company, power solutions for industrial, telecom, auto, cloud, and some more. Up nearly 30% year to date. Just kind of wanted to single it out because there was a lot of momentum there. So there you have it.
Okay,
what?
you got...
Are you judging over? You know, we didn't miss this last week.
Tim, what do you got?
All right, I'll jump in here. How's that? Let's start with some of the decliners that were notable, at least to me. Tesla down more than 2%. An interesting note coming out from JP Morgan analyst who said investors should proceed with caution because the EV maker is in danger of weaker performance, cutting earning estimates for the company after those first quarter delivery numbers that we got last week disappointed investors. JP Morgan lowering its EPS estimate for the first quarter to 30 cents from 43 cents in its 2026 outlook. To $1.80 from $2. Also, its 2027 forecast came down as well. But this is my favorite one of the decliners.
Let's see it.
This is for Isabel. Invesco. Look at this. IVZ. Okay.
That was big news, written by Katie Greifeld.
This is huge news, down 5% today. The company is going after the NASDAQ 100, the Qs, the iShares NASDAQ 100 ETF. It would trade under the ticker IQQ. If it does launch, it would become one of just a handful of U.S.-listed ETFs to solely track the NASDAQ 100. It would be the first one to not be managed by Invesco. Isabel, why did this take so long? Like, why isn't there more competition for QQQ?
I think Invesco had the license for the longest time, and now I think maybe they trust BlackRock and they said, sure, you can do it. But I think the big story here is Invesco said they're creating a foundational ETF ecosystem that does not happen overnight. And there is only one QQQ. That's what Invesco said. And again, that's written by Katie Greifeld. I thought it was a really sassy and good response.
Wait, she's not working, but she's...
I guess she's working.
Working.
She's on assignment.
Wow.
Shares for Invesco shares down more than 5%. Finally, watching what happened with shares of Oracle today, some personnel changes at the company. Hillary Maxson will be its CFO. It'll help navigate, she'll help navigate massive data center development plans and an accompanying cash crunch. Oracle pouring tens of billions of dollars into building AI infrastructure. That's required unprecedented financial maneuvering. It's projected to result in the company being free cash flow negative all the way to 2030. Shares were down much of the day, then went into the grain ever so slightly, but still finishing the day down 0.6%.
All right, let's check in on yields and, well, try to stay awake here. Not a whole lot going on. We should point out this is still effectively a holiday for a lot of folks here. We saw that reflected in the low volume in the equity market, even lower volume in the debt markets right now. A bit of stasis there. You can read it on your screen. Carol.
Oh, wow. Okay, yeah, I got it. It is pretty quiet. Here's an interesting story. In order to live in New York City, families need over $125,000 in income to live in any borough. So we're talking about six-figure incomes to live without government assistance. It's interesting to put those two together. In all 5 boroughs of New York City, there's 2 new reports that are out. One is from the city, and then another one, it's just kind of, I don't know. They're basically just saying you need a lot of money to live here. So kind of interesting.
Yeah. So, I mean, families with children, you mentioned $159,197 to cover the cost of living here. I don't need to tell everybody about the cost of childcare. 46% of households are not earning enough to survive without financial assistance. 62% of residents were experiencing economic insecurity in 2022. So, look, Zohran Mamdani, he was elected mayor of the city on a promise of making it more affordable. He certainly has his work cut out for him.
All right, we got to wrap this up soon, but I do want to end on a little bit of a brighter note and a higher note. Everyone's focused on, whatever's going on in the Middle East, affordability here in the U.S. and in New York. But there actually is something that we can rally around, and that's this mission, this Artemis II mission, around the moon, we should say, not necessarily to the moon. And earlier today, we officially got word here that this is now the first time, or I guess the longest, manned space flight that we have ever taken. It has now surpassed Apollo 13, which had traveled a total of roughly about 250,000 miles or 400,000 kilometers from Earth. We have now surpassed that. And of course, a little bit later, in just about, maybe about 3 or 4 hours Eastern time, we are actually going to get the closest to the moon since basically we set foot on it back, 50 years ago.
They're talking about naming the 2 craters. The first suggestion was Integrity, and the second was Carol, after the mission commander's late wife. That's pretty sweet.
No, it's actually
after
me. Actually after me. Did you not hear it?
That is true. It's Carol, yeah.
Listen, I kind of love this.
Everyone loves it. Is there a reason why they didn't have a press conference about this at the White House today?
Because there were eggs to roll? Should I just leave it there?
Yeah, just leave it there.
Yeah, it's kind of one of those days. Anyway, we wish everybody up in space well, and we'll be monitoring them. And of course, later on around 7 p.m. Eastern, we'll be also focused on them again. Romaine, it's just so great to have you back.
Imagine bringing the country together over something that we all sort of are into.
Yeah. All right, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Isabella and Romaine continuing there on The Close on TV. Tim and I continuing on Bloomberg Business Week Daily right here on Bloomberg Radio. Folks, we will see you again, same time, same place, on what will be maybe a more active Tuesday. We'll see you tomorrow.
And our coverage continues here on Bloomberg Television, a focus on energy markets, a conversation with former Energy Secretary Ernest Moniz. That's coming up after the break. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Miss Belly.
And I'm Romaine Bostic. Another interesting day on Wall Street. A low volume day to be sure, coming out of the Easter holiday. Passover still swirling around, but the S&P 500 adding about 0.4% on the day. A big part of the boost that we got came out of the banking sector. In fact, 5 straight days we've seen bids into that space ahead of the start of earnings season with those big banks next week. Meanwhile, Brent crude remains elevated once again, right around $109 a barrel, and a brief flirt above 70,000 for Bitcoin, but now Isabel at 69,000 and change.
We're looking at some movers here. We're looking Micron up by 3.5%. This comes even after the stock is facing challenges. The shares are down some 20% after hitting a high 3 weeks ago due to concerns about memory sector and, of course, the overall uncertainty in the broader market. It's also concerned due to the upcoming listing, U.S. listing, of South Korean rival SK Hynix, which will only add to its challenges. But today is looking like a good day with shares up by more than 3%. We're now going to Tesla, which is going the opposite direction. Stock is down by more than 2%. Tesla investors, according to JP Morgan, should proceed with caution because the EV maker is in danger of weaker performance. The analyst there cut his earnings estimates for the company after the first quarter delivery numbers disappointed last week.
Yeah, it's interesting you end on that here because there has been a big focus on renewable energy, and that actually brings us to our top story, the 6-week-long disruption of energy supplies through the Strait of Hormuz and the economic ripple effects now making their way to the U.S. That concern actually popped up today with that latest Institute for Supply Management survey, which showed a slowdown in the U.S. services economy and the biggest jump in 3.5 years in prices paid for those services and materials. And that was largely because of the war in Iran. And I want to point out something interesting. NYMEX crude futures traded in New York, they historically trade at a discount to Brent crude futures. That flipped on its head last Thursday, with WTI prices surpassing their London counterparts for the first time since 2022, with the premium itself for WTI relative to Brent at the widest since at least 2009. And it's raised a lot of questions about the global pricing of oil and just how insulated a net energy exporter like the U.S. actually is from the broader ripple effects of a prolonged disruption of one of the world's key waterway shipping routes. I want to bring into this conversation Ernest Moniz. He's the former Energy Secretary and currently the CEO of the EFI Foundation. And Mr. Secretary, I do want to start off on this idea of how prepared U.S. energy infrastructure, or more importantly, U.S. energy policy was for a prolonged disruption of one of the key routes for oil and gas.
Well, it is quite surprising, Romaine, that the Strait of Hormuz has not had better protection, if you like, from the threats and impacts that Iran has had on shipping. As you indicated, that has raised the price of oil very substantially since the pre-war days, and also, as you just said, flipped the usual discount of WTI, of Texas grade oil from Brent. So I think the ripple effects, as you said, are continuing, and frankly, some of the largest waves may still be lapping on us because a lot of the supply chains are only now beginning to feel the increase in prices. And so unless there's a very, very rapid lifting of the clouds from the Middle East, I think we have to expect ongoing, probably increased inflation as the effects come in various timescales. We are seeing various commodities going up now, and there are still delayed effects such as the impacts on fertilizers, for example, in diminishing potentially crop yields down the road in a few months. So I think we're still fairly early in this game, unfortunately, and we'll see how these prices develop.
But I am curious, just on a hypothetical, if for some reason we did get a resolution to this war, and more importantly, a reopening commensurate with the pre-war flow out of the Strait of Hormuz, the second order effects of that with regards to fuel, fertilizer, et cetera, chemicals, how fast do those prices potentially revert back to the mean, if at all?
Well, I think we'll see some of the prices going back fairly quickly, but we should be prepared for a very long impact. As we know, it's not only oil, by the way, LNG, and then other commodities. Sulfur, a huge amount of the world's sulfur comes out of the Mideast, and that's essential for making certain fertilizers, for example. Helium is another commodity that's absolutely critical for semiconductors and other uses. Huge amount coming out of Qatar. And I mention that because, of course, energy infrastructure in a number of the Gulf Arab countries has been hit. And in particular, the Qatar has said that some of the damage inflicted on its natural gas facilities, which also produce sulfur, produce helium, some of those effects, they are saying, could take up to 5 years to repair. So with the anticipated increase in the natural gas markets in the next years, we may be seeing continued elevated prices more on the year timescale than on the weeks or month timescale.
Shifting gears a little bit, what's the realistic path to containing Iran's nuclear program right now?
Well, right now the nuclear program clearly is not operating, given the strikes on it already going back to last June, so clearly they are not capable right now of enriching. However, all of that technology was indigenously derived, and unless there is continued military pressure and or diplomatic resolutions, and of course I would strongly favor the diplomatic resolution, we have no reason to think that they cannot reconstruct that program. A second major issue, and to me the highest nuclear priority for the near term, is finding out where and in what form the so-called 60% enriched uranium is. They had nearly half a ton of that, and not emphasized enough in the media is that that material could have been directly used and still could be directly used in a nuclear explosive if they have access to it. Clearly, the analysts think that much or most of the material is in one place in Isfahan. I'm not convinced. Certainly, some of the intelligence we have seen in the public sphere could have been manufactured by the Iranians. We just don't know. And I think, frankly, it's going to take diplomacy, and it's going to take, in my view, the return of the international inspectors in order to hopefully resolve where that material is and how the threat can be eliminated of that material. Moving it out of the country, downblending it. There are several options, but I don't see a credible military option as being available to answer those questions.
All right, Mr. Secretary, always appreciate you taking time for us. Ernest Moniz, the former Secretary of Energy for the U.S. Meanwhile, we are getting some breaking news here. Shares of Humana spiking, as are most of its peers right now. Medicare has now finalized the rate of reimbursement that it will pay these companies at 2.5%. Now, remember, early in January, a proposal had been released showing that the Medicare and Medicaid services was going to cut the rate from 6% the previous year to basically 0 for the next year coming up. They have now finalized those numbers, and that percentage now is at 2.5%, so down significantly from the previous year, but much higher than what had been telegraphed to this market just a few months ago. You see CVS Health up about 5% in the post-market trade, Humana up about 10%. We'll get you some more details on that, but stick with us. This is Bloomberg. All right, we continue to focus here on the markets and, of course, the read-through that we're getting from the situation in Iran. With the president holding a press conference today, no real clarity on what happens next. But our next guest says they're telling clients to stay nimble given the uncertainty. Stephanie Pierce, she joins us here in Studio 2. She's deputy head of BNY Investments. Great to see you, Stephanie.
Great to see you as well.
I imagine clients have a lot of questions these days, but it really does kind of get to this idea of, like, are people sort of looking for sort of how to position around the end of, I guess, this conflict, or how to position around, I guess, the idea of maybe a prolonging or a prolonged nature of what's happening over there?
That absolutely is the perennial question. And there's really three key messages that we're giving clients right now, since we don't know what we don't know. And those three words are resilience, diversification, and quality. And by resilience, there's really two meanings to that. Number one, now is a great time to pressure test portfolios to really make sure they are durable to the degree that this is prolonged. Our base case is that, and continues to be, that the U.S. economy will be resilient. Diversification, meaning that this is also a great time to look at things like global equity infrastructure, value, large cap value, areas that have a little bit more ballast, a little bit more defensive properties in an environment like this. And quality is really a lean toward higher quality fixed income, shorter duration fixed income. Again, a little bit of a hedge against potential credit risk or interest rate risk should that become an issue.
Are you surprised that given all the turmoil out there, we didn't maybe see a little bit more of an embrace of crypto, Bitcoin, crypto, and some of the other digital assets?
Well, look, we are not necessarily focused on the near term, as you know, as the leading digital asset custodian. We're really focused on the long term and the innovation that we continue to work on for clients.
Is there a long-term story still there?
We believe so.
Yeah.
Again, less about crypto per se and more about the blockchain and the broader innovation opportunity. From our perspective, one of the things I see in this market, it feels a little bit like when we learn to ride a bike, right? First, you learn to balance. Then you add pedals and brakes.
Okay.
And now we're getting ready to take the training wheels off.
Okay.
And so the example
I like that analogy.
I mean, we all remember that. I had training wheels. My kid had a balance bike. But the way I think about it, if you look at tokenized funds as an example, tokenized funds in the U.S. regulated by the SEC are about $1 billion. Doesn't sound that big, right? But from nowhere, mostly cash funds. But what's meaning they're cash instruments inside them. But if you look at what they really are today, they're largely traditional funds with a mirrored share class or a mirrored version on the blockchain. So if you were to think about what that looks like in the future, we're not that far away from where we're blockchain first, right? Where the true books and records are actually on blockchain. And it's the reverse of where we are today, where the backup becomes the traditional rails or traditional book and record. And that's really what we're excited about as BNY. We're kind of in the middle of that with clients. And so it feels a little bit like being a kid in a candy store if you're sitting where I'm sitting, where we have the whole ecosystem and we get to innovate inside that.
So what does the future of tokenization look like for you? Are you planning to tokenize each of your funds or just select? I mean, we're seeing headline after headline of companies launching new tokenized money market funds or ETFs or share classes of an ETF.
Well, like I said, I think what you're going to see is kind of an inversion from what we have today, where most of the funds that are quote unquote tokenized are actually mirrored versions on the blockchain of a traditional fund. So what BNY is doing in our kind of custody and our traditional rails is overlaying blockchain technology and kind of blockchain infrastructure, but using the same risk and control and kind of institutional grade framework that we use for the traditional infrastructure and integrating this on top, which will then allow for us to have what we call digitally native or blockchain first offerings. If you think about the benefits of that for investors, it's faster, cheaper, more transparent, more flexible. Sometimes I like to think about it as kind of tokenization creates sort of an asset management in a box experience for us at BNY.
I am curious too about the melding of kind of more, the traditional finance companies, and there's nothing more traditional than BNY, given your history with some of the newer ones here. There was the Treasury release earlier today about the Trump accounts, and BNY is involved, and particularly though as custodian and settlement for Robinhood. Is that did I get that right?
So we'll be. We're very proud and honored to be part of this as the financial agent for the U.S. Treasury. And as you know, we have a long and storied, very big established relationship with Treasury with what we do in our clearing collateral businesses. So we really see our role here as an extension of that. But we're equally thrilled to be partnered with Robinhood, who has a longstanding history of really bringing the democratization of finance and broadening access to more Americans. And that's what we're really excited about this announcement today.
Stephanie, always love the conversation. Stephanie Pierce, Deputy Head of BNY Investments. And a quick check here on the post-market trade. We're seeing shares of United Health, CVS, Humana, all surging here in the after-hours trade after the U.S. Medicare program released its latest reimbursement figures for the next fiscal year, 2.48%. That's down from the previous year, but much higher than the 0% rate floated back in January. We'll be back in a moment. This is Bloomberg. All right, we should point out it is Financial Literacy Month, and we are going to get some interesting consumer data coming out over the next 24 hours. That includes consumer credit, a little bit more of an insight into the impact of what's been happening in the Middle East. Now, our next guests have spent years helping their customers build their credit through rent payment programs. Wemimo, Abbey, and Samir Goel are the co-founders and co-CEOs of Esusu, and they join us now here in Studio 2. Great to have both of you back once again.
Thanks a lot for having us, Romain.
And we've spoken before in the past, particularly about how to build credit, but also, I mean, we have kind of this unique situation, at least here in the United States, where if you have no real credit history, you're actually not really considered to be credit worthy to a certain extent. So what is the process for younger folks going into adulthood, trying to actually build a credit profile for themselves that is actually responsible?
You make a very good point. Mm-hmm. There are over 110 million Americans that rent. 80% of them do not have their rental data reflected on their credit report. Mm-hmm. We just launched a report that's sort of called the Rent What Report that looked at Gen Z, the future generation, asking a fundamental question. How are you feeling from a financial health perspective? 60% of them said they're treading water. They're trying 60% of them. Wow. They're trying to figure it out. And above all, 30% of them said when it comes to getting a mortgage, the rent they pay is more expensive than their mortgage. Yeah. So 10%, when you think about it, that's a massive, massive demographic number for us to grapple our minds around.
But when we talk about housing, whether it's buying or renting, and we've seen so many numbers. I mean, there was a great story earlier today, average price of a home in San Francisco, over $2 million. We had a story here today in New York that if you work in New York, any of the boroughs, you basically need a minimum of $125,000 just to sort of make it, which, of course, a lot of jobs don't pay that. So it gets to this idea of how do you even approach your finances, particularly if you live in a major market like a San Francisco or a New York or even a Chicago, when you're kind of coming into it at a deficit.
You bring up a great point, and I think one of the challenges that we're facing is these problems are often seen as sort of intractable. Mm-hmm. There's nothing that you can do. And what we always preach is you got to start with the basics, right? So number one, know sort of where you're at. A lot of young people haven't proactively been thinking about their credit, but there are basic things that people can do. For example, making sure that your landlord ensures that your rent is being reported to the credit bureaus or signing up as an individual. Mm-hmm. People underestimate that, but your credit score is sort of your financial lifeline in our system. So without good credit, you can pay up to $250,000 more in costs for your debt over the course of your lifetime. Mm-hmm. And it can preclude you from better housing opportunities, better jobs, and now even sometimes dating as a joke. But really, credit has a really significant role in everyday people's lives, and it's something you can do something about today.
Wait, is that now? I'm so far out of the dating pool. But is that
there's
really?
There's a dating app that literally checks if you have a good credit score.
That's genius, actually.
Okay, all right.
So
she says that's genius. I'm like, wow, that's terrifying.
Responsible. It's a partnership.
I'm married, but I hear a lot of my friends. It's a bleak market out there. But if rent actually, as a renter, starts counting into our credit history, what does that actually change for when we start to? I say we as if I'm part of it, but I am part of it. When we start to actually purchase a home?
That's a fantastic question. So what we see from Esusu's data, we report our landlords have 12 million renters in all 50 states and see over $100 billion in gross lease volume. The average credit score goes up by 53 points. So if you want to buy a home, it's a huge difference from being subprime to prime. So when you can improve your credit score, we can go back as far as 2 years to capture 24 months of your historical rent payments. So we did a report, a 2025 report that looked at what is the economic activity that has been generated across our ecosystem. We've seen folks that have improved or established their credit scores have gone on to unlock $77 billion in economic activity. And to your point, $49 billion in mortgages. Those are people that will never get mortgages in the American financial system that today, because of reporting rental data, and through us, got $49 billion contributing to the American economy.
That's pretty incredible. So you need the participation, though, of the landlord.
No. You do not need the participation of the landlord. Amazing. Historically, we work with the landlord. We've deployed a direct-to-consumer model where anyone can go to our website, download our mobile application, and get access to it. We also recently partnered with Zillow, one of the most reputable prop tech financial technology platforms in the world, where now Zillow consumers can go on their website, apply to report their rental data. So we've democratized access, starting from a trusted source, historically working with the landlords, now across to all renters in the United States.
You've been doing this for a while with Esusu. Is the message getting out there?
Absolutely. And you can see that in partnerships like Zillow. There's a reason that we're working alongside them, because right now, every month, 228 million people go to Zillow's site, but many of them are aspiring to be homeowners or aspiring to get into a better renter. And one of the key building blocks for that process is credit, right? So for a partner like Zillow to be so interested in this only signifies the importance of this work. Furthermore, the federal government just a few months ago announced that VantageScore 4 needs to be used in underwriting single-family mortgages originated by Freddie Mac and Fannie Mae. The key difference in VantageScore 4 is the incorporation of rental data. So this is seen as critical from both a policy standpoint and a market leadership standpoint.
All right, well, great to have both of you here once again here in studio. Wemimo, Abbey, and Samir Goel are the co-founders and co-CEOs over at Esusu. Now, we need to go back to that breaking news. We should point out in the after-hours trade, 6 of the top 10 movers to the upside, of course, are healthcare companies. That's on the back of a new story out on the Bloomberg terminal here that the U.S. Medicare program has set the rate that it will pay private insurers for 2027 at 2.5%. Senior Bloomberg Global Business Editor Michelle Cortez joins us right now to explain why this is significant. And Michelle, I guess we have to go back to January when it looked like that number was going to be 0. What happened?
It did look like the number was going to be 0. The Trump administration has really been dialed in on getting healthcare costs under control in the United States. And one of the ways that they were going to do that in terms of the budget was to not increase the amount it paid for these private insurance plans called Medicare Advantage. Millions of Americans use these plans in order to get their health care, and the government was going to stop increasing the amount that they pay them every year. This is trillions of dollars. And what happened was there was a huge sell-off. The company said, look, we're not really going to be involved in this space if you are going to cut how much money we make so much, because, of course, costs have increased. So companies were pulling back. Americans were getting concerned about it. And the government caved. They're going to increase that rate by 2.48% in 2027.
Yeah.
A huge boon for investors.
But I am just curious, though, too. It did seem like we were supposed to come in. I mean, what was it last year? It's 2020. Was it like closer to 6% or something? So this is still a significant drop.
It is still a significant drop, but of course, it's all about expectations, how much investors had thought that there was going to be the amount that was going to increase over the coming years. In January, they said it was going to be flat. Investors said, look, just give us 1% or 1.5%. And in fact, the government came in at 2.48. So just much better than what the expectation was.
Talk to us about the actual implications of this with the pay of 2.48%. It's really a meaningful improvement. What are you expecting in the immediate aftermath?
It is an immediate improvement. It's so interesting because, in fact, a number of companies have said that they were going to get out of this space. So we see different companies that are going to benefit because they stayed in. We see United Health is going through the roof today. Humana is benefiting, CVS. All of these big insurance companies that are still in this Medicare Advantage space. So we know that we're going to continue to see them reaping gains month over month, year over year, for at least the foreseeable future. We'll see what happens in the out years. If the administration does come back, Chris Klomp, who is the one who is running a lot of the CMS programs now, has said that he really does expect and want these Medicare Advantage programs to start dialing back their costs, and he's going to expect that. But if they do it too quickly, then the companies are going to pull out.
All right, Michelle Cortez, our Bloomberg senior editor there. We should point out Humana was down 28+% just on a year-to-date basis. Coming in today, United Health was down 15, Molina was down 17. All of them have really taken it on the chin after that January announcement here about a potential no increase. All of those stocks right now pushing hard into the green in the post-market trade. This is Bloomberg. All right, well, the 2026 college basketball season here in the U.S. nearing the final buzzer. A big game later tonight, Michigan and UConn tipping off for the men's title game. And this follows an exciting women's game with UCLA coming out victorious last night. All of this unfolding as President Trump actually looks to make his mark on the multi-billion-dollar industry, directing federal agencies to, quote, bolster the effectiveness of college sports rules on transferring eligibility and pay for play. It's a new world, and Adam Breneman has been following it closely. He is the co-founder of the College Sports Company, a key investor in this space, and of course, a former college star himself. Adam, great to talk once again here. I do want to start with that executive order. Let's face it, controversial. This hits a lot of issues. Some folks are very happy with the transfer portal, like myself, because I feel like it adds a lot of excitement. Other folks seem to think that this is basically the end of the NCAA as we know it. What would an executive order like this, limiting the amount of years that folks can play in college, do, if at all, anything?
Yeah, I mean, this is a huge executive order because college sports has been a mess for a long time, and President Trump now putting his pulse on what actually is going to happen in the future. The biggest impact is the one-time transfer rule that would come into effect in this executive order, where players now only get to transfer one time but before having to go sit out a year after that first transfer. There's multiple players in the national championship game between UConn and Michigan that would be ineligible if this executive order was in effect before this year. So that could make a huge impact on what it actually looks like. Of course, there will be lawsuits, and how legal this executive order actually is will become the big debate. The NCAA President Charlie Baker said he actually likes parts of this executive order, and he's going to use it as leverage. But this is really more of a political move than a solution for the future.
But I think about, the fact that we just went through what seemed like, decades of lawsuits when it came to the idea of compensation for the players, something the players ultimately won. And we're now in this new image, this new era of name, image, likeness, something that you've been involved with in helping players sort of capitalize on that. Overall, that's been a net positive, I would think. It hasn't necessarily ruined the game, or has it?
It certainly has not ruined the game. The sports of college athletics have been a business for everyone but the players for far too long. There's been media companies, there's been the institutions, there's been the sponsors, the advertisers. Everyone has made money other than the players for decades on decades, and now the players finally have a seat at the table. College athletics has never been stronger. The viewership for college football, the viewership for the Final Four, for the NCAA tournament has never been stronger than it is right now. So despite everyone thinking college sports may be ruined, it is not. People are more excited. The athletes are staying in school longer because they're getting paid, which means the product on the court or on the field is even better than it was before. Yes, there's a lot of problems and a mess to clean up, but college sports is very strong right now.
And private equity is circling college sports. Talk to us about the benefits for and against taking private equity money. Who really benefits when it comes to this?
Yeah. Well, private equity isn't coming because schools want it. They're coming because schools need the money. These schools have a serious revenue issue where schools are now sharing their revenue with student athletes to the tune of $20+ million per year. So every school's trying to find this money. What private equity looks like in college athletics varies drastically. Some of it is really private debt, where it's a loan to the school paid back by future revenues. We see some schools that are actually spinning off their athletic department into a separate entity that becomes a venture arm of the school that can actually take on investors. But as you guys know, the biggest issue is that these schools are just that. They are schools. They're not for-profit businesses. And the question is going to be whether an athletic department can actually behave like businesses once they do take on that private equity money.
Yeah, this offseason is going to look interesting. A lot of issues at play, and I'm actually looking forward here to seeing not only, of course, the NFL draft coming up, but really the NBA draft as well, WNBA too, given some of the success we saw this season. Adam, great to catch up with you. Adam Breneman, co-founder of the College Sports Company. And just a reminder here, for all you folks who have been tracking the NCAA tournament, don't forget to type BRKT on your Bloomberg terminal to keep track of the latest leaderboard. Our brackets for cause leaders there as we now move into the final stretch with the big game tonight. That will say, look, Peter Grauer is number 2 Is this rigged? Wow, our former chairman there. Anyway, good luck to Peter as he moves into tonight. All right, we want to switch to another highly anticipated sports event. We're about 2 months out from the World Cup, which is potentially expected to bring in an influx of tourism that will drive economic gains, even despite some of the current geopolitical issues. We spoke with Alex Lasry. He's the CEO of the New York, New Jersey host committee for the World Cup. We spoke with him last month about the tournament and the potential profits that it may bring.
This is going to be something where we are activating the entire region and really showing it off as the capital for sports and entertainment. I think what we are expecting, though, is a very heavy international contingent coming here to participate, and not just for the teams and the fans of teams who are playing here. We're also expecting fans from people whose teams aren't playing here, and that's why we want to provide those watch party experiences so that they're able to come here, have a home base, and spend their money here in New York to drive that economic impact.
Well, let's talk about some of those watch party experiences. Joining us here in Studio 2 is Paul Caine, the president of On Location, the official hospitality provider for the tournament. Paul, great to see you again, my old friend.
Great to see you, too. It's like old home week over here.
Absolutely. Well, let's talk about the experience. I mean, obviously, there's going to the games, the matches themselves, but a lot of the activity, particularly the economic activity, is going to happen outside that stadium with the actual events and the experiences that your company is there to help provide.
So, On Location is the official experience and hospitality partner for the World Cup. We also were the NCAA this past weekend, and we're doing the Olympics in LA, and we do over 760 events a year. So we do the world's largest events. And as you pointed out, the experiences are in the stadium and also outside the stadium. But what we are excited about is bringing people from all over the world, over 100 countries, coming to the World Cup to experience in 16 cities, 104 matches, the world's largest sports economic event.
Now, I am curious, though. I mean, obviously, this is going to differ a little bit from the NCAA, given the international component of fans and, for that matter, teams. Given the geopolitical issues, the war in Iran, and just some of the political rhetoric, has there been any concern that we might not quite meet the attendance, the international attendance that we were looking for?
So we're seeing a gangbuster tournament right now. We surpassed the level of Qatar a long time ago. We're seeing this past week, single tickets went on sale, and we saw that go like wildfire. So if you want to go, this is the time to go. I mean, you should go on our website, onlocationexp.com, and see all of the amazing tickets and hospitality that's available. But I'll tell you that right now, we are very optimistic that not only will people from North America go to all 16 cities, but people from around the world are coming.
Talk to us about the real economic impacts of these mega events. What do they do to the cities? I know it varies, of course, case to case, but give us a few examples.
So sports travel is a booming industry. Right now, it accounts for about $600 billion a year in total economics, and that really goes right to cities, hotels, restaurants, all of those experiences. In just about 5 to 10 years, it's going to go into the trillions. So this is the fastest growing segment. Why that matters, and it goes back to your question about global attendance, people want to go and see great cities, but they want to go with purpose. And that's where coming to the World Cup really comes to bear. And imagine, and it's more than just going and sitting in the stadium. You know, that's a seat. Anybody can sit in the stadium. When you come with On Location, you're getting an experience. You're getting unique seating. You're getting to meet players. You're going to walk on the pitch. You're going to get your photos taken with a trophy. There's so many different wonderful experiences. I mean, one of which is for the finals. You know, we're imagine sitting on the field in like a couch setting while you're watching the finals of the World Cup. Those are the kinds of things that On Location does.
What about LA 28? Are you seeing anything already underway there? Some traction gaining?
Oh my God! The last couple of weeks, it's all been LA 28's been doing really, really well. So we went out with the first launch on ticketing and hospitality packages, and already it's trending way ahead of Paris. I mean, we've already sold more suites for LA 28 than we sold in all of Paris. So this already is going to be it. And North America is all about sports right now and all these incredible finals. We have the NCAA tonight, of course, the World Cup in less than 70 days. And then when LA 28 comes around, it's going to be like nothing else. This year, 2026, is the world's largest sports year. in North America. There'll be more commercial work going on in sports this year than anywhere else. Just had Milan Olympics, World Cup coming up. We have the NFL draft you mentioned. The NFL season is just around the corner. So much going on.
All right. Well, it sounds exciting, Paul, and obviously you busy guy these days. Great to have you here.
Great to be back. Thank you.
Paul Caine there, president of On Location. All right, we'll be back in a moment. We're going to set you up for what to watch over the next 24 hours. This is Bloomberg. All right, well, we started off today on Wall Street, a lower volume as to be expected, but a fourth straight day of gains that we saw now for the S&P 500. Modest gains, but I think some folks will take it.
It's a gain nonetheless, and it's really impressive amid all of the things happening. It's actually hard to imagine that equities are into green.
Absolutely. And of course, now the market will turn their attention to some other things that could potentially move the market over the next 24 hours. And we start off with some economic data, including durable goods here in the U.S., consumer credit, and then some of those weekly employment changes we get out of ADP. What do you think is going to be most important for folks to look at tomorrow?
Honestly, for me, it's the Fed speak. I mean, we have Fed Cleveland President Beth Hammack saying that it may be appropriate to raise interest rates if inflation remains stubbornly high. I mean, how the tables have turned. We were talking about a hold, and then now we're talking about a raise. Yeah, absolutely. And we're going to hear from Goolsbee and Jefferson. But also, we're going to have a sit-down with New York Fed President John Williams. Michael McKee is going to interview him right here on Bloomberg. That's right around 8 a.m. New York time during Bloomberg surveillance. Be sure to check that out for everything he has to say. And then about 12 hours from that time, 8 p.m. Eastern time, that is the self-imposed deadline that the President of the United States has put on Iran to reopen the Strait of Hormuz. Yeah, it's 8 p.m., not 12 midnight. I feel like there's confusion there. It's really, I mean, something investors should watch out for, especially after all the whipsawing in the headlines we've seen. Absolutely. The volatility does continue in oil markets with WTI and Brent crude camped out around $110 a barrel. More coverage from the political side comes at the top of the hour.